I need to talk about what's happening. Fuel prices in Australia have hit a record high. Petrol is approaching $2.50 a litre. Diesel is above $3 in some areas. Over 100 petrol stations in New South Wales have run out of diesel. The government has just announced it's halving the fuel excise for 3 months starting tomorrow. That's a $2.5 billion emergency measure. The reason? The US-Israel war in Iran has effectively closed the Strait of Hormuz, which handles about 20% of the world's oil supply. Brent crude has surged 59% in March alone, the steepest monthly gain in history. The RBA has hiked rates twice this year to 4.1%, and the rate cuts that everyone was expecting for mid-2026 have been completely taken off the table. Property headlines are screaming doom. SQM Research has slashed their Melbourne forecast to -2 to 6%. Buyers are pausing, auction clearing rates have softened, and everyone's asking the same question: should I wait? Today, I'm going to explain why the answer for the right suburbs at the right price point is no. And I'm going to show you 3 specific Melbourne suburbs under $750,000 where the fundamentals still stack up. Let's get into it. Before we dive in, if you're new to the channel, I'm Sean and I run PropSpotter. We're a property research advisory built on 3 pillars: research, source, and coach. What that means in practice is this: we use over 30 institutional grade data sources to identify the right suburbs for your strategy. Then our proprietary listing system monitors those suburbs like a hawk 24/7 and alerts you the moment a new property goes live, before most investors have even opened domain or realestate.com.au for that day. And then we coach you through every step from evaluation, comparables, due diligence, and settlement via a dedicated one-on-one group. It's everything a buyer's agent provides: the research, the sourcing, the guidance, except you keep the skills, you stay in control of every decision, and it costs a fraction of the price. We've coached over 50 investors across Australia with a perfect 5-star rating on Google. If you want to learn more, the link to book a free strategy call is in the description. Now, let's get into the data. Let me give you the 2-minute version of what's happening globally, because understanding this context is critical for making smart property decisions right now. On February 28, the US and Israel launched military strikes against Iran. The conflict has escalated rapidly. Iran has threatened to fire on any ship passing through the Strait of Hormuz, the narrow waterway on Iran's southern border through which roughly 20% of the world's crude oil and gas flows. Shipping has come to a virtual standstill. For Australia, this is a direct hit. We import about 90% of our refined fuel, petrol and diesel, mostly from Asian refineries in South Korea and Singapore, which themselves rely on oil coming through the strait. 6 tankers bound for Australia have already been cancelled or postponed. The energy ministers confirmed that Australia's fuel supply chain is under genuine pressure, though he does say that we are a long way from rationing. The flow-on effects are everywhere. Higher fuel costs push up the cost of transporting everything: food, building materials, consumer goods. That widens inflation, and wider inflation means the RBA keeps rates higher for longer or hikes further. They've already raised the cash rate to 4.1%, with 2 consecutive increases in February and March. For the property market, this creates what some analysts are calling a double pressure effect: rising costs and softening demand at the same time. Economists from HSBC, AMP, and others now expect the cash rate to remain in or at above 4.1% well into late 2026 or even 2027 if the conflict drags on. Now, here's where I'm going to push back against the doom narrative, because if you actually take some time and look at what happened to Australian property during every major crisis over the past 50 years, the answer is almost always the same: not much. Go back through the data. The Gulf War in 1990, September 11 in 2001, the GFC in 2008, COVID in 2020. In each case, transaction volumes dropped, buyers paused, sellers pulled back, but prices didn't crash. Australian housing markets absorb uncertainty through lower volumes, not lower values. And in the years following these crises, prices almost always accelerated. And right now, the structural forces supporting property haven't disappeared. Australia's population is still growing, net overseas migration is still running at elevated levels, the housing shortage is still severe, building approvals actually fell 7.2% in January 2026, the weakest since June 2024. We are building fewer homes while adding more people. That fundamental equation hasn't changed because of a war on the other side of the world. What has changed is sentiment. And sentiment creates opportunities for investors who think in decades, not in news cycles. The key insight here is this: affordability is now the dominant force in the Australian property market. The RBA rate at 4.1%, combined with fuel and food price increases, has crushed borrowing capacity for a huge segment of buyers. That means the suburbs that will hold up best are the ones that are already unaffordable, the ones that sit well under first home buyer price caps, where people still need to leave and still need to rent regardless of what's happening in the Strait of Hormuz. Let me show you why this matters with real numbers. At a cash of 4.1% with APRA serviceability buffer, the median household borrowing capacity has dropped significantly compared to where we were 6 months ago. Buyers who could stretch to $800,000 are now capped at $700,000 or less. That compresses demand downward into the more affordable price brackets. At the same time, the expanded 5% deposit scheme has price caps that sit close to the median house prices in many suburbs. In Victoria, that cap is $800,000 for metro areas. So there's a government-supported floor of demand at the affordable end. First-home buyers using the scheme are being funneled into exactly the price bracket we're about to discuss. And here's the other factor: people still need roofs over their heads. As long as net migration remains positive, and it is, rental demand will stay strong. Tight vacancy rates protect your rental income even if capital growth slows. For an investor, the ability to hold through a downturn without financial stress is everything. And that's driven by cash flow, which is driven by yield. Which brings me to the 3 suburbs. First up, Melton, with a median of $584,000. Melton is the standout. A typical house price of $584,000 with a gross rental yield of 3.7% based on median rents of $415 a week. That's comfortably under the $750K bracket, well within the first home buyer scheme cap and delivering meaningful cash flow. But the price isn't what makes Melton interesting right now. It's the infrastructure. A $560 million contract has been awarded for level crossing removals at Craigieburn and Exford roads, including a brand new Melton station. This also enables larger 9-car velocity trains on the Melton line. The level crossings will be gone by the end of 2026 and the new station will transform the suburbs' connectivity. The sales volume tells you something important too. 204 annual sales means this is an active liquid market. There are 4,900 estimated dwellings with a population of nearly 8,000 adults. This isn't a ghost town waiting for development. It's an established suburb with existing infrastructure that's about to get a major upgrade. Now, the honest risk. Melton has a lot of new supply coming. It sits in one of Melbourne's growth corridors. You need to be selective. Established houses on existing streets will outperform new house and land packages. And I wouldn't recommend buying at the very outer edge where amenity is thin. Focus on stock close to the new station and the established town centre. Suburb 2, Diggers Rest. Diggers Rest is the suburb in this list that I find the most compelling from a yield perspective. A typical house price of $665,000 with a gross yield of just under 4%, $507 per week in rent. That's the highest yield of the 3 suburbs we're covering today. Diggers Rest sits on the Sunbury line, which now runs directly through the Metro Tunnel into the CBD. The level crossing removals at Old Calder Highway and Watson's Road have been completed, making the Sunbury line fully level crossing free. Trains between Water Gardens and the CBD now run every 3 to 4 minutes at peak. For a suburb at this price point, that level of public transport connectivity is exceptional. The population is still growing, about 5,700 adults in roughly 4,100 dwellings. But it's not a massive growth corridor like some of the outer suburbs, which means less risk of oversupply. The combination of strong yield, direct metro tunnel access, and a price point that's accessible to first-home buyers makes this one worth serious research. The risk here is that in a rising fuel cost environment, suburbs further from the CBD can face headwinds because commuters feel the pinch more. But the metro tunnel connection largely offsets this. If you're on a direct train line to the city, you're insulated from the worst of the fuel crisis compared to suburbs that truly rely on driving. Craigieburn is slightly above our $750,000 benchmark at $761,000. homes. But there's plenty of stock available under the cap, particularly established 3-bedroom houses away from the newest estates. The yield is 3.5% with median rents at $508 per week. What makes Craigieburn interesting is its scale. This is a suburb of 24,700 dwellings with over 65,000 adults. It has 1,150 annual sales. That's enormous liquidity. When you eventually sell, you won't have a trouble finding a buyer. The rental pool is equally deep with over 1,400 leases per year. This is a genuine suburban economy, not a frontier outpost. The infrastructure story here ties back to the metro tunnel. The Craigieburn line, which previously shared the city loop capacity with the Sunbury line, now has significantly more services because the Sunbury line has moved to the tunnel. That means better frequency and reliability for Craigieburn commuters without a single dollar of new construction being needed. It's a second order benefit that most investors completely miss. Craigieburn also has the full suite of 20-minute neighborhood amenities: train stations, schools, medical centers, retail, and established cafe strips. It passes the lifestyle that many outer suburbs fail, which protects your future buyer pool. Look, I'm not going to pretend the war in Iran doesn't matter. It does. Higher fuel costs are real. Higher rates are real. The economic uncertainty is real. But here's what I keep coming back to. The investors who built the most wealth over the past 50 years in Australia weren't the ones who timed the dip perfectly. They were the ones who bought quality assets at fair prices and held through the noise. The suburbs I've shown you today: Melton at 584,000, Diggers at 665, Craigieburn at 761, all sit within the first home buyer affordability bracket. They all have strong rental demand. They all have infrastructure upgrades that are physically being built right now, regardless of what's happening in the Middle East. And they all have the kind of fundamentals: transport, schools, amenities that support long-term demand. Will they dip a few percent in the short term? Maybe. SQM is forecasting Melbourne could pull back 2 to 6%. But if you're buying at prices that stack up on cash flow and you're holding for 10 plus years, a temporary dip driven by geopolitical shock is not a reason to sit on the sidelines. It might actually be the window. To wrap up, the Iran war has created genuine economic headwinds for Australia. Fuel prices are at record highs. The RBA has hiked twice, and property market sentiment has softened. But the structural forces, population growth, housing shortage, rental demand, they haven't gone away. And affordable suburbs with strong infrastructure are the ones best positioned to hold up and recover fastest. The 3 Melbourne suburbs I'd be researching right now are Melton for value, Diggers Rest for yield and metro tunnel connectivity, and Craigieburn for scale and liquidity. All under or near $750,000, all with genuine infrastructure catalysts. And if this is the kind of data-driven suburb analysis you want for your own investment, personalized to your strategy and budget, that's exactly what we do at PropSpotter. The link to book a free strategy call is in the description. I'm going to be covering the same angle for Tasmania in my next video, where to find affordable, high-yield suburbs in Hobart despite the fuel crisis. You don't want to miss it. See you in the next one.